It's hard to believe, but here we are, 3/4 of the way through 2023. Here's a review of what happened in the third quarter, as well as a few things to think about as we head into the end of the year. Hi, my name is Eric Blattner. I'm with Divvy Wealth Management, and thanks for watching. Before we get into the third quarter recap, first I want to remind you that you can go over to divvywealth.com. It's DIVVI wealth.com and sign up for our blog. We typically send out emails once a week or so with different observations or thoughts on the market, different planning opportunities, things of that nature. Or you can go over to YouTube and subscribe to our channel, search at Divvy Wealth Management, and you'll get notified anytime we upload a new video. So with that being said, let's talk about what happened during the third quarter. And it was a little bit reminiscent, at least from a return perspective, of what we faced in 2022. So if you get a little deja vu when you look at your quarterly statement, it's understandable. Interest rates moved higher, stock and bond prices were largely lower. And so this first chart is going to show the returns for stocks. If you look at those orange charts, pretty much everything was down during the quarter. There was energy was able to buck the trend. Energy returned about 12% during the quarter, but most everything else was down. U.S., international, large caps, small caps, growth stocks, value stocks, just about everything fell. So with that as kind of a backdrop, we already mentioned rates, and here is a chart that shows what we call the yield curve, and this is the U.S. Treasury yield curve. And so when you look at this chart along the bottom axis, the bottom horizontal axis, you'll see a bunch of numbers, 1 through 30. And those are years or maturities or quote unquote tenors for these individual bonds. So if you look at the number 1, that's a 1-year bond. The 5 is a 5-year Treasury bond. The 10 is a 10-year Treasury bond. The green line represents where interest rates were at the end of the third quarter. The dashed orange line shows you where interest rates were at the end of the second quarter. So the difference there is what happened between June 30th and September 30th. And then for those folks that are interested, we've also got that brown line at the bottom of the chart. That shows you where interest rates were 3 years ago. So that would be end of third quarter 2020, just starting to come out of COVID, maybe a little bit. And we've obviously come a long way over the course of the last 3 years. The main part of the chart here that I want to draw your attention to are those years 10, 20, and 30. And what you will see is that interest rates there rose pretty consistently from the mid threes to mid to high threes to the mid fours, somewhere in that ballpark. The short end of the curve, the 3-month, 6-month, 1-year bonds, those interest rates stayed pretty consistent quarter over quarter. So what does that mean for bond prices? Here you go. This chart shows the returns for different bond indexes during the third quarter. Again, the orange bars represent the 3-month, and then the green bars represent year to date. When you see those moves like the ones that I called out, those 10, 20, 30-year bonds, the interest rates rose, you can see the impact that it had really in that second and third column, the 20-year Treasury and then the long-term Treasury. So a lot of folks generally think of bonds as being quote-unquote safe, and this is just perhaps a not-so-friendly reminder that bonds do carry risk. And when you see interest rate movements like we saw in the third quarter, bond prices can fall significantly. That long-term Treasury index lost almost 13% during the third quarter. So it's always helpful to keep in mind kind of that teeter-totter effect. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. So what we've been experiencing really throughout 2022 and most of 2023 is in stark contrast to the interest rate environment from the early 80s, really through the late 2010s. And that was really an environment characterized by high starting rates, and they were pretty consistently falling for the better part of 40 years. And so now we've seen the reverse of that with interest rates starting to move higher, and we're starting to be reminded of the impact that can have on asset prices like stocks and bonds. So After bonds, let's take a quick look at some of the factors that we monitor. And these are just different ways of kind of slicing stock markets to group stocks together by a certain characteristic. And so, high dividend stocks, quality stocks, stocks with low volatility, things of that nature. And what you see here in this chart, again, the orange bar represents the third quarter. Everything was lower. There wasn't much that worked during the quarter. High dividend yields, quality stocks, value-oriented stocks, stocks with momentum. It didn't matter. Everything was lower, at least through this lens, during the quarter. And then lastly, I want to take a quick look at some of the longer-term trends that we have really been following for quite a while now. The first is that phenomenon of large caps outperforming small caps. And this chart shows a few interruptions there, but the way to read this chart, if it's moving up and to the right, that means large caps are outperforming small caps. If it's moving down and to the right, that would mean small caps are outperforming large caps. So you can see on the recovery, after the recovery from COVID, small caps started to outperform. But for the most part, for the last 15 years, the trend has been up and to the right, which means large caps outperforming. And so when you think about companies like Microsoft, Apple, Google, Nvidia, Facebook, Amazon.com, to name a few, these are big behemoth companies that continue to perform on a relative basis better than the overall market. So you see that trend line moving higher. Another trend that you've probably read about is this growth versus value trend. And again, similar, if it's going up and to the right, growth is outperforming value. If it's going down and to the right, that means value is outperforming growth. And again, for most of the last 15 years, growth has been in a position of leadership for the most part. Again, there was an interruption there, a pretty stark interruption, as we rebounded from some of those COVID extremes. But generally speaking, growth has been in a leadership position. And this chart would show you the same thing, only comparing US stocks versus international stocks. US investors have fared much, much better investing in US companies over the last 15 to 20 years. Really, you'd have to go back to the mid 2000s, kind of that 2003 through 2007 timeframe, to find a period where international stocks outperformed for U.S. investors. So the last comment that we'll make here is we kind of go back to that idea of perhaps a new trend, where we mentioned the tailwinds from 1980 through the late 2010s with higher rates falling. And now you've seen the opposite. Remember that yield chart we showed, the short end of the curve moving up. Money market rates are about 5.5%. I should have the data off the top of my head here, but I don't. So if I can find it, I'll link to it in the comments below. But you can see money market inflows. The amount of money coming into money market funds has been historic, as investors have really moved to take advantage of some of these higher interest rates, some of the safety that comes along with money market. And for a lot of folks, earning 5.5% while being patient is not a bad place to be. So you've seen this trend line here that compares T-bills, which is the very short end of the curve, think 3-month type of investments, versus Treasury bonds, which is going to be the 30-year bond making a loan to the U.S. government for 30 years. And for most of that time, the 30-year bond was in a position of leadership. That's where the line is going down and to the left. And then we've seen it reverse. So now this is bills versus bonds. So when bills are outperforming, the line is going up and to the right, as it has been here for the last couple of years, really since interest rates have started to rise. So those are a few observations, at least at a high level, of what happened during the third quarter. And next, we will turn our attention to some ideas to consider for Q4. All right, so let's spend a few minutes talking about some different considerations as we head into the end of 2023. Now, I'll start just by saying, as I typically do, that I think forecasting, particularly over short-term windows, is really challenging to get right on a consistent basis. But there are some different trends. There's some different, I think, considerations that we should acknowledge as we head into the year, because there's reasons to be cautious, and there's probably also some reasons to be optimistic, both over the short and longer run. So let's talk about a few of them. First and foremost, I think the biggest, at least headline that we are, I guess it's relatively new, some of the geopolitical issues. Now, we continue to have concerns about, Russia's continued invasion of Ukraine, what it means for that world, what it means potentially for commodity prices, not just oil, but also soft commodities like wheat, things of that nature. But just recently, you've also had Hamas attack Israel, and starting to, I think, try to put pieces together in terms of what that might look like and implications, at least, aside from the humanitarian aspect of it, which is very, very real, which we absolutely want to acknowledge, but then also thinking about what that potentially means for markets as well. That's part of our job. So those are all concerns, and particularly from a geopolitical issue, those types of events are very, very difficult to try to project. But I think one thing that we do believe is that anytime there's heightened uncertainty, that markets tend to get a little bit more volatile. And so expecting a few more ups and downs is probably reasonable at this particular point. You've also got continued concerns about recessions. As we headed into the beginning of 2024, most of the economists that we talked to thought that a recession was imminent in 2023. And while it hasn't materialized yet, most of the folks, again, that we respect in this regard, think that a recession is still relatively likely in 2024. So that doesn't necessarily mean that we have to avoid stocks or reposition everything to prepare for that type of environment. But it is certainly something that we want to be aware of and acknowledge as we monitor the risks that might be in our portfolio and make sure that they're intentional. We also are, plenty of talk about interest rates, and we spent a little bit of time earlier in the video talking about the move that interest rates have made during the third quarter. And as we look out into Q4 and even 2024, understanding that a lot of the geopolitical issues that have been surfacing could put upward pressure on oil prices. There could be some continued pressure on onshoring and deglobalization. Those issues tend to be inflationary as well. So if the Fed needs to keep rates higher than expected for longer, understanding what that could potentially mean for asset prices like stocks and bonds. I think, again, we got a reminder of what that could potentially look like in the third quarter, and something we'll want to keep a close eye on heading into the end of the year. On the flip side, I think there's also plenty of reasons to be optimistic. Generally, over the long term, we are very optimistic that markets tend to reward patient investors who are able to stick to a long-term plan. So nothing that's happened in the third quarter has changed that view. Nothing about our outlook for the fourth quarter has changed that view. But very specifically thinking about the next 3 months, the fourth quarter historically has been the strongest quarter from a U.S. stock perspective. Since 1950, I've seen a couple stats here recently, and we've pulled a little bit of data. Since 1950, the fourth quarter, the S&P 500 has been positive about 79% of the time. And the median return during those fourth quarters was over 5%, which both of those stats are among the strongest when you compare to the first quarter, second quarter, third quarter. Fourth quarter has historically been pretty positive for stock investors. That's even more true when the first part of the year has been strong, which it has. Now, again, we know a lot of the strength in the market has been concentrated in a few pockets. So that kind of makes us pivot into some other areas where we probably feel like we have a little bit more control. We think the fourth quarter is a great opportunity to revisit some of the planning aspects that we talk about with clients very regularly. These are going to be things like your retirement contributions and 401k plans, things of that nature, making sure that you have contributed the amounts that you wanted to contribute heading into the end of the year. And if you're short in any way, shape, or form, it's a good time of year to kind of true those up. Also, tax planning. Fourth quarter is a fantastic time of year to revisit your expectations around tax for 2023 and think forward to 2024 and try to answer those questions. Should I be doing anything differently to position myself better for taxes next year? Now, this goes hand in hand, but tax loss harvesting, we mentioned earlier in the video that a lot of the market's gains this year have been concentrated in a few growth-oriented pockets of the market. So there's plenty of stocks, there's plenty of sectors that are well below their highs. So there may be some opportunities for investors with a lot of taxable assets, brokerage account assets, things of that nature, to revisit cost basis and unrealized gains and losses. And to the extent that you've got some unrealized losses that you would like to realize, that you'd like to harvest to offset either gains this year or in future years, it's a great opportunity to take a look at some of those issues. So fourth quarter is always a great time of year to revisit kind of the planning checklist and make sure that you've got ducks in a row heading into the holiday season and into the new year. So with that, we'll wrap for today. Thanks as always for watching. And again, if you'd like to follow along, I'd encourage you to go over to divvywealth.com. That's DIVVI wealth.com and sign up for our blog there, or go over to YouTube and search at Divvy Wealth Management and subscribe to our channel. If you have any questions or would like to discuss, by all means, please reach out. There will be a link below that will tell you how to get in touch with us if you'd like to do so. And until next time, thanks again for watching.